Welcome back to Success with Steven. My name is Steven Smith. On this channel, we discuss all things financial literacy. Last week, I was speaking with one of our subscribers about a strategy to access over $300,000 in capital and then how to actually deploy this capital into cash flowing assets. This is something I believe that everyone would enjoy. So today I want to break down this strategy, the one that you can use to get up to $300,000 deposited into your bank account. And you can do this in 30 days or less for around, let's say, $240,000, but the full $300,000 will take slightly longer, and I'll explain why later in the video. You can make fast, clean offers, you can deposit cash to close on deals, and you can deploy capital into assets like your business or properties or anything else that can actually produce real cash flow. So without further ado, let's get right into the video. Before we jump into the banks, we need to talk about the requirements for this strategy to actually work, because stacking business lines of credit and loans is a little bit different than stacking credit cards. When you're stacking credit cards, lenders care a lot about your revolving profile, and they want to see that you already know how to manage available credit. They're looking at your utilization, your number of revolving accounts, your average age of accounts, your recent inquiries, and whether you have a history of carrying balances. That's why 0% APR credit card stacking usually has a higher bar. But if your profile is not structured with good to excellent credit and your file is thin, then the approvals get smaller or they don't come at all. Business lines of credit, business loans, and personal loans, especially when we're talking about funding, they deposit cash into your bank account and they're underwritten very differently. Yes, they still look at your personal credit in most cases because they will require a personal guarantee for each of these products. But if you have a solid baseline FICO score, a clean credit profile, it's actually easier to get approved. So here's the standard you want for this to work smoothly. You want to at least have a 680 FICO credit score or higher. However, the higher your credit score is, the easier this does become. You want a clean, structured credit profile, meaning no collections, no late payments, no derogatory accounts. You want utilization that is under control, because even if your score looks decent, high credit utilization will make you look riskier to lenders. You want your inquiries to be reasonable, at least 6 months old, no recently opened accounts in the last 6 months. Now, that doesn't mean if you have recently opened credit cards or auto loans or personal loans or mortgage, things like that, you wouldn't be able to get approved. I'm just giving you what the ideal situation would be. Now, can some people still get approvals under that 680 range? Sometimes, yes, they can, depending on the lender and depending on income, and the rest will be your credit profile and how it's structured. But if you want this strategy to actually do what it's designed to do, which is stack quickly, fund quickly, and deposit real cash into your account, then a 680 plus FICO score with a clean profile is the line. That's where things get more consistent. Now, once you meet this baseline, we can start the funding sequence with confidence, and that is when you start seeing 5 figures and 6-figure deposits hit your bank account very quickly. Now, if you do not meet those requirements, please check out my credit repair playlist. It is down in the description. There are plenty of videos there to actually help you clean up and build your credit the right way. All right, so now that we understand the requirements for this strategy, let's actually talk about the banking products that we're going to be applying for. All right, now before we break down this funding sequence, I want to clarify a few things so there's no confusion about where this information is coming from. First and foremost, every line of credit, every personal loan, every business loan that we're going to discuss, I was approved for firsthand. So I do have experience, and I'm giving you exactly my personal experience with getting approved for these products and services. Now, second, I have a dedicated video for each of these products at the time that I was approved, and I'm going to link them right here in this video. So if you do want to get more, let's say, specific data points and the credit profile requirements for the exact product, as well as bureau pools and things like that, then I highly recommend that you watch that video. Now, sometimes YouTube will not allow me to link every single one inside of this video because there is a limit to how many links you can include, but all these videos are on my channel. If you go to Success with Steven Smith, there's a magnifying glass, type in the name of the product or like a keyword of that product, it will come up and you can watch that video. Now, all of these products will be in order. So round number 1, we're starting with business lines of credit, and we're starting with the American Express business line of credit. And this is one of the most easily accessible starting points. And in many cases, you can see approvals up to $25,000. If you already have an existing relationship with American Express, in my experience, this will be a soft pull on Experian. Now, that said, your results can vary. underwriting policies can change, and depending on your profile, it could still be a hard pull. That's why I tell everyone to treat any bureau pull as possible going in, because even the most common data points can change. Now, if this does result in a hard inquiry, I have videos on removing hard inquiries, and for me personally, I remove hard inquiries for business products because they do not report to my personal credit. So next in the sequence is the Wells Fargo business line of credit. This is another product where you can see approvals up to $25,000, often with no documentation, and you should expect a hard pull from Experian. Now, I have updated data points that you can use in 2026 because what worked 2 years ago might not always work today, and you want current information before you apply. Now, again, every single one of these will have something very specific with them, so I highly recommend that you watch the video that corresponds with the product, because I'm not going to be able to go into every single detail about how that's going to work in this one video. So again, please go to the actual video where I go into detail about how to get approved. After that, we have US Bank, which is one of my favorite institutions for business products. Now, you can be approved for a $25,000 business line of credit, also known as a cash flow manager, and this will be with no documentation as long as you do $25,000 or less, and it will be a pull from Equifax. And again, all of my data points come from my own personal experience. I've done this within, I would say, at least the last 18 to 24 months. So things should not have changed that much, but if anything does change, just be aware that, that is a possibility. Now, finally, we have the First Citizens business line of credit with another strong option in the $25,000 range. You should plan for hard pulls commonly involving Equifax and Experian. And again, it's always possible that bureau pulls will vary by region or underwriting channel, but this is the general pattern that you should assume going in. Now, typically, I start with business lines of credit for strategic reasons. For many of these options, they're designed to be accessible without requiring extensive documentation upfront, which does make them ideal in early sequencing, and it can speed things up and make it so much simpler. So for example, with US Bank, I was able to open an account. I didn't have to deposit much of anything whatsoever. I had a checking, I had a savings account. I applied for that business line of credit, and I was approved with no documentation for $25,000. Now, that's probably the first place that I would recommend starting. After that, you can then go to a place like First Citizens, because I was able to then get a business line of credit with them for $25,000 the exact same way with no docs. Then you might want to withdraw the business line of credit cash and then stick it into a business checking account. It could be with really any one of these banks. But the reason why I say that is because American Express will actually link to your business account in order to approve you for their business line of credit. So if you're following this sequence, you're going to get two of them with almost nothing at all. You have another one that does check your business checking account, but you can withdraw the money and you can deposit that money into a business bank account. Now you're showing that you have $50,000 that American Express can look at to give you $25,000. And then last, you can put all of this money inside of Wells Fargo and show $75,000 if you wanted to. And yes, this will cost you money because you will be paying on those business lines of credit if they're existing, but you can take the same money and then pay it back. If you had to spend, let's say, $2,000 or even maybe $7 or $8 in order to have access to $100,000 in round one, then I would say that's a pretty good investment. So again, these products can be used to strengthen your overall funding position. And in certain cases, the capital you access through a business line of credit can be used to create healthier cash flow, meaning you take what the line of credit has to offer and you deposit it at another bank. That will strengthen your deposit relationship. Another reason why this will work well is for round number 2. Now, when you want to get the actual US Bank business loan, it is a SBA backed loan. They will ask for light documentation, meaning the same thing as American Express. They will want to see your actual bank account. But the great part about this is they don't care if it's a personal bank account. They don't care if it's a business bank account. All you have to do is deposit money and leave it in there for 90 days. They might get like 3 bank statements just to show that you have capital. And then from there, you can easily get approved for up to $50,000 without requiring any tax returns. Now, if you follow the sequence for rounds 1 and 2, you should be able to access $150,000 fairly easily. Round 3 will be personal loans, and this will always be last because you keep these hard inquiries. And once these loans report to your personal credit, it will become very difficult for you to get approved for anything else. So for example, when I took out my loans with Lightstream and Navy Federal, I couldn't get approved for a credit card, anything, nothing whatsoever for almost an entire year. Now, once again, I have a video on all of these products, so definitely go ahead and check them out. But I recommend starting with Navy Federal for the personal loans because they pull from TransUnion, and you can then put money into your account again to actually show that cash flow, that healthy cash flow, and you should be able to easily get approved for the max amount of $50,000 with Navy Federal. Now, the last one on our list is Lightstream. I have a video on this one going into great detail explaining how you can get $100,000 with Lightstream. I myself was able to do this. In that video, again, the entire sequence is in there. I started by asking them for $30,000. After that, I went ahead and got $40,000 after exactly 91 days. And then I got the last $30,000 after around 9 months. It was very close to a year. Now, I kept trying every month after 91 days to see if it was repeatable. But then, a few months I missed. So again, in that video, I go over it. It was fresh in my mind. So everything that I talk about in that video, again, fresh data points. And that wasn't that long ago that I did that. Now, I want to go over some steps after this because, yes, I've given you the entire funding sequence. Some of you are just going to, check out right here. This is where you leave the video. If that's all that you wanted, then awesome. But I do have some rules that I actually go by when it actually comes to using all of this available credit and actually deploying it properly. So if you want to learn how to actually do that so you don't have the same mistakes that I had when I ruined my credit and then had to spend at least 2 years cleaning that up, and it's kind of the inception of this channel and how everything else started, then, I want to help you by telling you my story and telling you what I learned so you can avoid making those mistakes. Now, rule number 1 is going to be only borrow for acquisition. Now, you've probably heard things like debt is slavery, never borrow money. If you can't pay cash, you can't afford it, and loans will ruin your life. And listen to me, there is a version where debt can absolutely ruin your life if you borrow to consume, if you borrow to impress people, if you borrow without a plan. Debt will drag you. But the reason I dislike blanket statements like all debt is bad is because it keeps regular people trapped while the elite use debt to speed run wealth. And let me ask you something. If debt is automatically bad, why do corporations use billions of dollars of it? If debt is automatically bad, why do billionaires finance assets instead of just paying cash? If debt is so bad, why do banks love lending to people who already have money? Because the truth is, debt isn't a trap. The trap is using debt like you're a consumer. The strategic borrower borrows to control assets. They borrow because they know what to do with capital, and they borrow because they can turn borrowed money into more money. And that is the difference between debt that destroys you and debt that elevates you, which brings us right back to rule number 1. Once again, you only borrow for acquisition. Strategic debt is acquisition. Acquisition means you're controlling something that produces measurable reoccurring value. Something that pays you, something that grows, something that has a purpose. And if the debt doesn't generate income, you're feeding the machine instead of actually building your own. So here's the simplest test. I don't want to spend a long time going over this, but if you have to pay a loan with, let's say, your 9-to-5 job for the long term, that's not leverage, that's just financing. All right, let's move on. So rule number 2, leverage is power, over leverage is collapse. Now, leverage magnifies everything. It magnifies returns, growth, momentum, but you know what else it magnifies? Your mistakes. So the same thing that can accelerate your wealth can accelerate your collapse as well. Over leverage happens when your debt obligations exceed your flexibility, and it happens when you have no margin. It happens when one disruption will turn into a crisis. So for example, if one tenant stops paying and your whole plan falls apart, then you're over leveraged. If one slow month in your business means you're sweating your loan payments, then you're over leveraged. If one rate change makes you panic, then you're over leveraged, and margin will be your survival. Now, think about it like this. Margin is the space between your income and your obligations. It's breathing room. It's reserves. It's the ability for you to stay calm. And if you do this sequencing properly and you have the correct credit profile, then banks will approve you for the max amount that we talked about. Their models will say that you can pay it back. but their models are designed to protect them and not to protect you. So yes, I gave you strategies, I gave you a plan to use capital, and hopefully to your benefit and not to your detriment. I don't want you to feel squeezed by this. So here's a principle that I live by. Never borrow the max amount of what you qualified for. If they approve you for $25,000, ask yourself if $10,000 is smarter. If they approve you for $300,000, ask yourself if $100,000 lets you sleep at night. Because the goal is not to be approved, the goal is to build something durable. Now, once again, if you've been watching me since the beginning of my channel, I started with my situation that I was in. I started with credit repair, and I actually came at like the tail end of it. I was able to repair my credit completely after around 24 months of learning everything I needed to learn about how to do this, and I shared that information with everybody on YouTube. From there, you saw my funding journey. You saw all the credit lines, all the credit cards that I was approved for. You saw the entire process. But before that, I over leveraged a few years prior, which caused me to be in a bad situation. And I would say that, in my opinion, I'm a pretty smart guy. But it doesn't matter how smart you are. This isn't about how intelligent you can be. It's about having a strategy and also ensuring that you're not taking on more than you can actually handle. And that is the issue that I normally see whenever I talk to people. They keep thinking that somehow their business idea will just start producing all this income and they don't actually make enough money to actually support it. So I'm telling you, with all the things that we talked about, if you were trying to actually finance $300,000 worth of debt, do not be surprised if you're paying $10,000 to $15,000 a month. At a time, that's how much I was paying to finance all that debt. So if you don't make $10,000 to $15,000 a month, you can't use the whole thing. It won't work. Use what you can. Don't use what you're approved for. Now that brings us to rule number 3, which is know the spread, because the math decides if you're winning or if you're losing. Now spread is simple. That's the difference between what the debt cost you and what the asset actually earns you. If the asset yield is higher than the cost of capital, you have a positive spread. A positive spread is how leverage becomes profitable. Now, if the asset yield is lower than the cost of capital, you have a negative spread. A negative spread is how people slowly drown while telling themselves they're investing. If you borrow $200,000 at, let's say, 6%, that debt is costing you $12,000 a year. Now, if the asset produces $24,000 per year in net income, then you have a $12,000 positive spread. That means the bank gave you money, and after paying them, you still made money. Now that is leveraging for profit. But if the asset only produces $10,000 a year net, you have a negative spread. You are subsidizing your own investment. You're paying to hold it. You are hoping that it'll appreciate and bail you out. And that is not the smart move. Hope is not a strategy. This is why you can't be attached to an investment. The only thing that matters is the numbers. And one of the biggest mistakes that beginners make is calculating the wrong number. They calculate gross income and not the net income. Gross rent is not your money. Gross sales is not your profit. Net is what's left after insurance, repairs, maintenance, management, and the real world chaos that will show up. I promise you, it's going to happen. If you've been doing this for a long time, a professional will assume that there will be friction. Amateurs will assume perfection, which is why I'm telling you, don't take more than you can actually handle. And if you can't handle it, use your job, save your money until you actually have enough that you can manage some debt. And that way you can pay it back until you actually see that you can produce a positive spread, and then you can scale from there. And rule number 4 is to deploy debt into compounding machines. Access to capital means nothing if you do not know where to deploy it. Now, the goal is not getting a loan. The goal is using a loan to buy and build something that compounds. Compounding is when an asset produces income, that income is reinvested, and the reinvestment will produce more income, then the cycle will accelerate. Now, a cash flowing rental property, it can compound if the monthly profit gets reinvested into your next acquisition. A scalable business can compound if borrowed capital expands proven operations faster than your expenses grow. Dividend producing investments can compound if dividends are reinvested correctly, but borrowing to reinvest in markets requires extreme discipline because volatility can punish sloppy leverage. And honestly, I don't recommend using like loans for actual investments. I would never say do that. That is a bad place to be. Only use your actual profit for, let's say, stock investments or anything like that, or Bitcoin, because those are not businesses and they are not treated the same way. Yes, they can actually make you money. You can never call when. You can never say when. It could take you 10 years. So unless you plan on paying for loans for 10 years, I'm telling you from experience, but you can do what you want. Don't do it. 9 times out of 10, you will fail. Now, digital assets, once again, just like those, they can compound if they're proven, not hypothetical. Now, what I like about digital assets, and that's pretty much how I built this new business that I have, is that the potential to scale is really, really easy because of the low overhead cost. You don't really need to borrow money to scale digital products and services. So remember, amateurs consume profits, professionals reinvest profits. So if your leveraged assets produce $1,000 per month, then that's really awesome, man. Like that is really good. Like $1,000 is a great accomplishment, but you don't upgrade your lifestyle by $1,000 per month. If you did, you just neutralized your leverage. That made absolutely no sense at all. You worked hard, you took a huge risk, you built something, and then you drained it for some temporary comfort or relief. That will always ensure your failure. However, if you reinvest that $1,000 per month, you activate compounding, and compounding is where the real freedom actually comes in. Now, I want to give you guys my final thoughts on this because there is a ceiling on personal income. I learned this after working various jobs. You can only grind so many hours. You can only give so much of yourself. If your income depends entirely on your time, your growth will eventually stall. And that is why leverage exists, because it helps evolve this. You stop thinking about only trading your time for money and you start thinking about buying assets. And then eventually you start thinking about building systems, because systems will allow you to make money without being present. And that's what you really want. You want a system that will produce consistent profit without daily labor. And businesses can also be a system if you build and process leadership the right way. Digital platforms can be systems if demand is proven and operations are repeatable. I have an entire business credit playlist where I talk about, all of this stuff. I talk about the right way to start a business. I try my best to, as much as we talk about credit and things like that, I try my best to give actual business 101 and beyond that. Like I try to give you everything possible to actually go from like level 1 to level 10. And as I'm doing this, I'm going along this process in my daily life. So I'm trying to take you along with me as I go through this. So I really hope that when I'm going, and taking my time to make this, because, making videos like this, recording like this, it takes a lot of time. Like my chest hurts from recording so much. Like it's hard. So I really do hope that when I'm doing this and I'm going above and beyond, that it is making a difference, because the goal is not just to replace your paycheck. The goal is to detach income from your presence. I don't even like money like that, if I'm being honest. I don't like capitalism, if I'm like being honest. I don't really even care that much about it. It's just what I was born into, and I just have to fight the monster that I know. And this is the best way that I know how to do it. It's to learn about it and to control it for my personal benefit. And then that's where I stop feeling like I have to hustle and grind every day, and I can actually breathe. And that's what I really want. I just want peace of mind and the option to do whatever I want to do. I want to thank you guys so much for watching this video. So let's tie this together. Debt is like fire. In the wrong hands, it could burn the whole house down, but in the right hands, it can power everything. Like it can be your engine. The bank isn't your enemy. There are other enemies out there, trust me, but it's not the bank itself. The bank is just a business, and they will profit from borrowers who consume. They'll also profit from borrowers who acquire. The difference is that strategic borrowers use the bank's money to build assets, cash flow, systems, and of course, the ultimate goal, the freedom of choice, or the illusion of freedom at the very least. So if you want to beat the system, then it starts with one decision. You stop borrowing for your ego and you start to borrow for acquisition. If you got value from this video, please make sure that you hit the like button, subscribe to the channel, and drop a comment telling me which part of this video hit you the hardest. Also, tell me what city that you're watching from, because I like seeing how far the community stretches. I mean, I know I've grown this pretty big, but it never ceases to amaze me to actually see where you guys are watching from. Once again, I want to thank you so much from the bottom of my heart for watching this video, and you guys have a wonderful day.